Hello and welcome. My name is Thorsten T, the founder of Dividend Stocks, Stocks to make long-term profit growth visible. This this video will look at dividend stocks on discount in May, which means that the stock market dropped. I was writing a blog article. I will show you about the winner and loser stocks in the last month, and you see that the losers lost more percent than the winners gained. And especially weak was the US market. Nasdaq dropped about 9% in May, and correspondingly we see a lot of technology stock, tech stocks, US tech stocks among the losers. But everything bad also has a good side, and it means that you get more bang for the buck, or you get higher dividends if the stock price drops. So maybe nice entry points by occasions right now, and we will check this out. Previously, I published a series on seeking alpha and dividend stocks on discount. Now I do it on YouTube with this video because basically I think that everything I do and everything I did in these seeking alpha articles you can do on your own. You just need to use the tools which are here, and then you don't need to wait for a published article. So let's go into the dividend turbo, and here we are. We scroll down, and then we see here the stocks, and you see here the historic dividend yield, including today and the estimate. And here you see the difference between today's dividend yield and the historic dividend yield of the last 12 months, the average. And if I'll enlarge the screen, if the numbers here are in green, it means that the current dividend yield is higher than the average dividend yield of the last 12 months. If it's red, then the current dividend yield is low. For example, we see that 3M, that the current dividend yield is 3.51%, and that this is nearly 0.8% above the average of the last 12 months. We can also see it nicely here. There's a dividend yield 3.5%, and then we see that going back in time, the dividend yield was considerably lower, 2.5% maybe, and here at the low only 1.88%. So it makes a huge difference if you buy the stock with a start dividend yield of 1.9% or 3.5%. And we also see here that in general, or that here we have a very nice dividend ladder. So it's a very solid dividend stock and a dividend aristocrat too. And there was only between the financial crisis, or in the financial crisis, that you were able to start with a higher dividend yield for 3M. But this is not a video about 3M. I just wanted to give you an idea how the dividend turbo works. So I need to log in first. Everything I just did you can do as guest. You even don't need to register. Now we are logged in, and the difference is that I can see more or all stocks now, and before the number of stocks was limited. To get an idea, or one way to get an idea if we have a lot of dividend stocks on discount or not, is very simple. We just display all stocks. It's 581 dividend stocks from all over the world, the most popular dividend stocks. And if we scroll down here, we are here about in the middle, and we scroll somewhat lower, and here these are the neutral zones, and we see here that it's below half. So all these stocks in this range here are dividend stocks on more or less discounts, and this part of the dividend stocks and the remainder, these are dividend stocks which have historically low dividend yield. So the majority of the dividend stocks is a bargain from this point of view. We need to be careful if we are dividend investors. We can't just buy a stock because the dividend yield is high, of course. An example is Centrica from Great Britain. Let's have a look at this stock, and then we see why this dividend yield is very high, because it will drop. Current dividend yield based on the last 12 months is 12.85%. It's very, very high, and it will drop to below 10% because there is a pending dividend cut here from 12 British pence to 9 British pence. That's also an advantage of the dividend turbo. You can see very fast here in this chart area if we have a dividend trap here. To avoid dividend traps or unreliable dividend payers in general, it's a good idea to discard stocks with unreliable dividend history. And this is easily done if you filter by dividend stability, which means that we only take a look now at the stocks with highly reliable dividends. And now, for example, we removed Centrica and the remainders. We have still 361 stocks from all over the world. So there are still enough to choose from. For example, we have Imperial brands now. And here they are. Tobacco industry is in transition mode, and transition mode means unsecure future. Unsecure future means that the stock market doesn't like it, which means that the stock price drops, which means that the dividend yield increases. So Altria is another example of a dividend of a tobacco stock. All these stocks, they shine with rather high dividends. I wanted to show you one stock more in detail to give you an idea about the fundamental analysis you can do, because it's not enough to look at the dividend history. We have to look at the fundamentals at profit growth too, and this is easily done by going into the full analysis. But first, let's choose the stock of the month, or of this video at least, which is Gap Incorporated. And Gap shines with a dividend yield of 5.2%. It was only nearly as high in 2016 for a very short moment. In general, the stock is a reliable dividend payer, and you see that in the history starting from 2000, the dividend yield was always well below the current dividend yield. It may be an interesting stock. Is it? Let's find the answer now. And here we are. And the two most important charts for the introduction or to evaluate the stock in general are these ones. Here are the per share metrics, earnings and operating cash flow per share, dividend per share. And in general, I'd rather say it looks nice. It's not a straightforward increase of profits, but there is an increase. At least I pretend I can see that. From left below to right above, in general with some hiccups. But if you look at the revenue and margins on the company level, not on the per share matrix, then we have a contradictory development. You see that the revenues are flat and that the operating margins are more or less on decline. So there's a contradiction, and the contradiction may be explained with share buybacks or share repurchases. And here we see the repurchase ratio, which is in the history very high, 9%, 7%, 5%, 12% even. So it means that Gap reduced the number of outstanding shares. We can also see it here in the balance sheet item treasury stocks here, which increases, and suddenly it's gone, which means that the shares were retired from 2014 to 2015, but it doesn't change that the share buyback continued in a lower rate here, but in last months with 7.2%, rather high once again. And this means that Gap was transforming its money into, or spending its money to buy back its shares to boost these per share metrics. That's not a very sustainable strategy. if you don't fix this issue here, which means flat revenues and decreasing margins. This alone is enough for me not to invest in such a stock. By the way, here you see a jump in assets. You'll also see a jump in total debt. That's it's related to debt obligations, which must be present now in the balance sheet. So it increases one's debts and one's the total assets, because these leases are now shown. That's, by the way, this is a general problem, and it translates in some matrix being not wrong, but they might lead to confusion, because between here and the application of this new accounting rule, the matrix will change without really something happening, but it's a technical change. But that's another point. What I wanted to tell you is that this stock, in my point of view, my humble point of view, is not a good investment. You can see here that it was not a good investment so far. If you look at the price history, then the current price is 18.17 and 18. And for example, in 2005, stock price was even higher and was much higher in 2000. And we see here that based on fair values, the stock is undervalued on the one hand, but on the other hand, we see here that the company has some problems. If you search for an alternative, for example, then and if you are not focused on US stocks, then for example, Inditex might be, not Intel, Inditex might be an alternative to you. It's a Spanish stock, and it's also a Spanish stock which dividend yield is an all-time high, 3.5%, nearly 3.4% to be exact. And here you see it's an all-time high. It's close to an all-time high. It was already somewhat higher here in the at the end of October 2018, but in general it's still very high, and the dividends are supposed to increase. We are not going to the full analysis. You may do on your own if you are interested in the stocks, but I wanted just to show you how this in general works. What's also interesting is the dividend alarm. For example, if Inditex might be interesting for you, you just add the required dividend yield here. For example, here you say that 3.4 is nice, 3.5% dividend yield is even better, and if the stock reached 3.5% dividend yield because, for example, the stock price drops, then you will get an email saying you or telling you, hey, Inditex just reached the threshold of the 3.5 dividend yield. Now, according to what you told me here, the stock is a buy. Just check here daily delivery, and it works. It works even as a member, as a free member. Okay, that's all for today. Thank you for watching. Have a nice time. Good investments. Bye bye.